Last week, we went over the risks of being all in on the market in retirement and utilizing high cash value life insurance as a volatility buffer. This week, we're going to talk about ways to find money to fund your policies. This could be maybe your first policy. Is there some hidden capital out there that you might be able to access so that you can get started? This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro. Unlocking hidden capital for somebody's first policy. What's on your mind, Carlo?
Well, I think the first thing that comes to mind is actually something that I kind of did. It wasn't necessarily directly allocated to doing my first policy, but it was probably around the time that I did. And it was a particular market turmoil environment when I think it was, 2021, 2022. Don't remember the exact time frame. But I just got to thinking that I was not super stoked about what could happen in the market. So I was like, I'm going to pull out a 401k loan just to shield some losses. And if you don't know, a 401k loan, when you're paying interest on that, it's just going into your own account. So whatever your interest rate is on a 401k loan, you pay that in it goes into your account, gets credited to your account. So you're not really losing anything. Now there is the opportunity cost of those funds, obviously not gaining at whatever rate the market is gaining at. But in my case, I was feeling like the market environment, the financial circumstances were kind of like this situation where I just wanted to shield some funds. And what that also does is when you take out that loan and just pay it back over time, your dollar cost averaging kind of increases. You're taking out maybe in ideal scenario at a high, and if there's some kind of correction, it can go in over time. But either way, it's just dollar cost averaging as you pay back that loan, increasing how you're doing those contributions. It kind of goes back in and gets allocated based on your allocation for your 401k. And I think it's a pretty interesting one that many people might have access to.
I like that. So you take the loan, let's say at 5% interest, that money, you pull it out, you get it out of the risk of the market, you get it into the life insurance. It gives you an instant death benefit increase. So if something does happen to you, your beneficiaries are better off in the near term. And you're now in a safe growth environment with that money. You're paying interest back to your 401k. So your 401k is essentially earning that 5% that you're paying as your dollar cost back average into the market.
And that's really what makes it super powerful, is that it's not really costing you anything except for that opportunity cost. If indeed the market just shoots up while you've done this, then it might not be the best thing in that particular circumstance. But the thing about it is, timing the market, not timing the market over time, wherever you're putting it, when you put those funds inside of these products and get them building over time, it's still going to have building compound interest over time as well.
Now, the risk of a 401k loan is if you lose your job, your employer might require you to repay that loan immediately. And if you're unable to, suddenly you got a taxable event and you got to watch out for penalties if you're not 59 and a half. So the beauty of using this to get money into a life insurance policy is almost all of that should be liquid. So if something happens unexpected, you could just take that loan from the cash value you've generated in your policy and repay your 401k loan all at once.
Yeah, and I think that's exactly why it's just such a powerful strategy to combine with this seeding of your own bank, is to build up your equity in that life insurance policy. That, yeah, if you lose your job, you can maybe float some costs there and also pay off that loan, whatever remaining balance you have. So I think it is a really powerful tool to combine with that 401k loan.
Where I usually look to get money for a policy, especially somebody's first policy, is I assume everybody has an emergency fund. And if they don't, they should have an emergency fund. So if you have some money set aside covering the next 3 to 6 months of potential expenses that you have a decent chunk of cash off to the side. Maybe it's a few $1,000s, maybe it's tens of thousands of dollars. I would much rather store that money inside of a high cash value life insurance policy than a checking or savings account that is essentially earning you nothing Or in the case of a high yield savings account, maybe it'll earn you a little bit, but it is taxable growth happening in that savings account. So if you have, let's say, a $10,000 emergency fund, and we want to design a high cash value whole life insurance policy, then we're going to slowly transfer that over from checking account or savings account into that life insurance policy. We can do that over the course of a few years without losing very much liquidity. As an example, let's say you have a $2,000 annual premium each year in that life insurance policy. The first year you have $10,000 in your emergency fund. You shift $2,000 over into the life insurance, and that becomes $1,500 in cash value. You now have $8,000 in the policy. You now have $8,000 in your savings account that's liquid, and $1,500 that's liquid inside the policy. But now you also have a significant death benefit, $100,000, $200,000 death benefit. Year two, you move over another $2,000. Now we're down to $6,000 in the savings account, but we're at maybe $3,500 or $3,300 in the life insurance policy in liquidity. Add that together, we're at $9,300. We're almost back to that $10,000. Couple more years go by, we're going to have more than $10,000 available in the policy by the time we've got the $10,000 depleted from the savings account. Meanwhile, the money that's in the savings account each of those years is all liquid and available immediately, just like a normal savings account would be. And if we have to dig into more than what's available in that savings account, it only takes a couple of days, maybe a week at most, to get at the money in the life insurance policy. Well, I say at most, but technically the insurance company can wait up to 6 months to give you a loan. That's just not the reality of what we see happening these days.
Yeah, I think what you described there for the strategy is really powerful because you're still keeping that safety of having your emergency fund accessible, and slowly you're building that back up, and you're reducing liquidity only slightly, but in the end it's going to be growing over time once you hit that break even period, and that will be a really powerful, even more powerful emergency fund, and a really good savings vehicle when you execute that strategy.
The beauty of having your emergency fund inside of a policy, we access that cash value via policy loans. But what do you do if you access your emergency fund? You have to refill the emergency fund anyways. So there's no issue taking a loan to access the emergency fund if you know that you have to just repay the loan anyways, because you need that emergency fund reestablished as soon as you're able to.
Yeah, and I think that's the thing. It's built into the system, and there's incentive for you to start paying that back as soon as you can, because there's going to be interest you're paying to the insurance company, but it is continuing to earn and gain compound interest while it's in that policy. So I think it really is a great place to park those emergency funds.
Yeah, and in this example, we only used the emergency fund to do the funding over a few years. But the reality is a lot of people do have some extra cash flow, and we can maybe move that emergency fund over even faster if they also have money that they're going to be contributing each month on top of that, or annually on top of that, in order to grow it quicker. So 401k loan, emergency fund, both good ways to kickstart your policy. What else do you got?
I think that there's tends to be various types of lines of credit that could serve as a good move, depending on the interest rate environment, depending on various things. There's things like a HELOC, but we've talked about a couple of times that, the dynamic banking, the velocity banking. Another strategy that I will continually kind of churn through is zero interest credit card offers that I pay off once that zero interest expires. So what you can do is sort of say, okay, I have this amount of monthly expenses. Start putting all of your expenses onto that credit card, and move the funds that would go to those expenses into a life insurance policy. At the end of that term, when your zero interest expires, you can take a loan against your life insurance policy and pay off that credit card balance. And maybe you might need to pull from somewhere else a little bit, just because the liquidity might be in the 80-90% range. but, it just depends on the policy design and whatnot, but that's a way that you could free up some capital without actually paying any interest to get it.
I actually would like that as ways to add additional paid up additions, but I probably wouldn't do something like that if it was the only source of funding for a policy, because you're going to end up running too close to the edge with how much you have to borrow out, and you may not actually have extra cash flow in this scenario. But if you're just using it to top off a policy, I love it.
Yeah, and I think that's the thing. It's you don't have to go to the extreme on completely tapping it and go all the way. It just really depends on your circumstances. But it's just like an idea that could be implemented. And I think James is absolutely right. You want to be careful with any of these types of things. Personally, as a general rule, don't don't pay credit card interest. And whatever you can do to not do that, like that should be the thing. So if credit cards are just not your thing and you've had a history of some problems with them, this might not be the move for you. I just call it out as something that I don't mind doing. I don't pay credit card interest, but it is a nice thing that is basically people letting me borrow their money for free.
Good points. Now, there were videos that I put out a number of years ago, 6 or 7 years ago on my YouTube channel. The idea behind the videos was finding money for your policies. And what I called them was wealth building blocks. They were generating wealth building blocks. And that can happen with any type of recurring expense that you might have. As an example, if you already own a policy and you just want to be able to increase what you're putting into the policy, if you have your car payment, you've got a car payment set to pay out for the next 5 years at $300 a month. You can take that 300 and do a one-time diversion into your life insurance policy. You have your payment, you're ready to make your car payment. It's not quite due yet, but instead of sending it to make your car payment, you send it into your policy. And then each month, what you're going to do is you're going to borrow from the policy to make the car payment. And when you would normally make the car payment with cash, you send that over to your policy and you make either a loan payment or an additional new paid up additions premium payment. When you send that money into the life insurance policy as a new premium payment, it's going to turn into almost $300 in cash value. It will likely turn into maybe something like $270 in cash value, somewhere around there. So you don't quite have the full 300 when you divert it over to the policy. That's why you only want to do this if you're adding on to a policy, but you can borrow the 300 to go make the payment. Now, that one-time diversion, if you just send the money over as new premium one time and then you just use it to pay the loan back. When you send 300 to pay your loan back, 300 is available to borrow again. Well, you're going to make that loan payment and it's going to sit in the policy for a few weeks before you need to pull it back out to make your car payment. So we're offsetting interest during those few weeks. And then we're just reaccessing that money via our line of credit, which is our life insurance loan. What will happen over time is that $300 is going to grow and compound each year. But the interest that you're paying by doing that loan and by doing the loan payment and borrow against it, the loan payment stays exactly the same. So if your loan interest over the course of the year is 5% interest on $270 or $300, you're paying $6 in interest. That first year, the 300 that you diverted into the policy is probably going to turn into $304 or $305 in cash value. And then the next year, it's going to go and turn into $308. And the next year, $312, and then $318, and then $325. And it's going to continue to grow and compound each year. This is a very small number that we're talking about. But meanwhile, your loan payment each year, your loan payments each year add up to the equivalent of essentially $301 each month instead of the 300 that you would have been paying. You're getting the growth and compounding on the tax-free growth part of the life insurance policy, and your death benefit continues to grow. But the amount that you continue to pay on that bill only went up slightly, and it stays the same the whole time. So that's how the wealth building blocks work. And you can do it with any type of expense. So the more money that you have to be able to do this with, the greater the savings and compounding will be.
And I think that is really that's like an anecdotal example of kind of the infinite banking in practice. And this is kind of the concept why Nelson Nash in his book talked about funneling all of your income through it. I'm not saying everybody should do that, but what James is talking about there is a really powerful thing because over time, the amount of compound interest that principal, that single extra premium payment of that $300 that you continue to cycle through, that's going to continue to earn compound interest over time. You're reducing how much interest you're paying in there, and that continues to grow and grow and grow. And you could scale that up. I mean, what we're talking about is small numbers, as James mentioned here on this example, but maybe you have bigger expenses. Maybe you have other things that can really add up. It's all relative, right? Like depends on what your financial situation is, and that can be a real path to building those wealth building blocks and having that great financial foundation.
Yeah, and those videos that I put out demonstrated the concept. It shows the actual numbers so you can see how it works. But the reality is if you're going to institute something like that, you're not going to want to be tracking every penny that you're moving over, and you're not going to want to move money every single week. You don't want to spend hours and hours and hours just trying to move these little small dollar amounts to try and get a little bit of compounding. It's more about getting into the practice of moving money efficiently. So look it up for the value and just understanding the concept of moving the money efficiently, how we divert our money one time and how we can make that work for us. But understand that the actual goal is automate as much of your movement of money as possible so that you spend only a very small amount of time optimizing the movement of money, but you're getting the compounding growth and the long-term massive effect of what should be just a small amount of your time.
Yeah, and I think that also leads into where I had mentioned earlier, just briefly, and we didn't dig into it, is combining that concept possibly with a HELOC and having that ability to move funds quicker because a HELOC can have funds clearing your account instantly, effectually, and you can implement that in the mix and kind of play with interest rates. I mean, that's the thing too, is depends on the interest rate environment. But if you're really looking to get started, it is possible to use a HELOC. I don't know that right now is probably the right environment for that, to use a HELOC to do your initial funding on a life insurance product. It's not that it would necessarily be bad, but it's just the interest rates are higher than they have been historically. But in the end, it could be a way you do it, and then you make that one big payment because actually making the one big payment, it tends to be a bit more efficient, and then you just make your payments over time. You might already have the cash flow that is you already allocated for making that premium payment, but you can make that big payment with your HELOC and then make those monthly payments to pay off that HELOC throughout the year. And that can be another thing that you could do in order to get that initial funding going.
I talk to clients about this regularly where rather than making monthly payments on a policy, especially a whole life policy where insurance companies will charge you a premium, they're going to charge you extra. It's usually like 5 or 6% extra to make payments monthly as opposed to one annual payment. The numbers almost always show that you're better off borrowing from some other line of credit, making your annual payment, and then just make your monthly payments back to that loan. And you're going to end up with savings on the fees that they charge to do monthly payments, but then also a little bit quicker growth and compounding that will happen inside the policy than what you're going to pay for interest when you just pay the loan back over the course of the year.
Yeah, and I think that's the thing is as you were mentioning earlier, the efficient use of money, efficient movement of money. I think that's really what this is about. And there's a lot of ways that you can use various lines of credit, and that's what when we're talking about this strategy overall in terms of the infinite banking concept, or what I like to call net wealth finance, we're talking about adding lines of credit that most people don't have. And so I think that's what makes this really powerful. And it's an effective tool for building wealth that when you have access to something like this, you can start to think creatively about how you tackle any financing needs.
All right, other ways to find hidden money. Check your couch cushions. Utilize the roundup feature. You can have your bank do your automatic roundup on any debit card transactions where they're setting it aside into a savings account. And then every once in a while, you just grab the money from the savings account and put it into your policy.
Yeah, and we've talked about a few times, like you might have a brokerage account and, securities-based line of credit or your margin on your brokerage account. There are ways that you can do that. There are risks with that. I think if you are, as I mentioned earlier on with the 401k problem, and maybe you're sensing something, maybe you've got some big capital gains that you have long-term capital gains that you want to just go ahead and capture. Just because an example where at one point I had a big position that basically 10x at one point. I had held it for over a year, and I was like, all right, well, I don't know what the situation on this particular position is going to be, so I liquidated it. I don't know that I directly put that into a life insurance, but sometimes I do that. So I will have cash funneling through a brokerage account sometimes. So you might be in that situation where you have some cash that's sitting in brokerage just because you're waiting for something. And that might be an opportunity for something like this as well.
And I'll finish up with check with family members. Maybe you have an inheritance coming your way from your parents, or they have enough money that they have to start worrying about estate taxes. They can gift you money up to like $19,000 a year from each of them, gets it out of their estate. If they know that you're going to be inheriting it anyways, maybe they're willing to give it to you early and you can start using that to fund a policy.
Yeah, that's a really creative one because I mean, I think that for some people who have some parents who have a little bit of money, and you don't necessarily even have to worry about the estate tax. I mean, that can be a consideration in the equation. But if your parents have some money, you have that ability to have that annual gift limit that they can just give to you without any tax implications, and it can be a helpful thing on this process as well.
Well, the federal estate tax exemption is pretty massive at around 13 million, maybe 14 million now. But some states, the exemption only goes up to a million. So it could be more important for some people in those states where that estate tax, it kicks in at a pretty low number.
Yeah, absolutely.
All right. Next week, we're going to talk whole life and direct versus non-direct recognition when it comes to the policy loans. Which one is better? This is a lifelong debate that we tend to get into between all of your infinite banking practitioners. I think we'll be able to enlighten you a bit on our thinking in this regard. We'll see you next week. I'm James Barber, your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.